Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market had a momentary shaky start for the new year, but then investors kicked the party into high gear to the point of a drunken buying frenzy. Monday started the week with big selling as races tightened on the Georgia runoffs and investors shuffled positions for the new year. Tuesday, stocks got a lift as energy stocks moved up as OPEC extended their production cuts, and investors anticipated a Republican win in Georgia, leaving the Congress in gridlock. Wednesday, it was clear the Democrats did win the Senate, and they own all three branches of government. Investors paused overnight and then, realizing a fiscal spending frenzy is coming, rushed into stocks, and they crushed the bond market and sold off gold at the same time. The Russell 2000 at one point was up 100 points. That was about a 5% gain as the financial sector got pushed up very strongly, and banks were bought all week long as that yield curve steepened, which is a help for bank earnings. There was a big disparity as at the same time techs got sold off very hard. The NASDAQ at one point on Wednesday, with the Russell up 100, the NASDAQ was down 300 points at the worst, as investors thought about higher taxes, breakup threats, and higher regulations for that tech sector. The rally on Wednesday was cut short by the riots at the Capitol building in a horrific spectacle. In an effort to block the Biden certification, an angry mob stormed the Capitol, climbed the walls, broke through doors, and that absolutely darkened, maybe forever, the message of the thousands of peaceful protesters out there that were Trump supporters. The message certainly was lost based on that, and it's proof that the actions of a violent mob are the antithesis of the purpose of the First Amendment. So investors, shaken by those images, sold stocks into the close. Thursday, 2 a.m. in the morning, Biden finally got certified, and stocks jumped again. Financials surged again, joined by industrials and many of the stock sectors, which moved up very significantly, expecting to benefit from coming fiscal spending, and maybe the potential of $2,000 checks versus the $600 stimulus checks they're getting now. Why not just make it $2,000 a month? I mean, in this environment, who knows what we're going to get? Friday, stocks gained again. There was a surprise loss of jobs, 140,000 jobs lost, and that's the first job loss in this report since April. And here we are still in a period of where bad news is good news, and stocks started to move up again, but now got a little shaky, and they've been really choppy here on Friday during the day. The stock market now hit our upside target for January that we showed in the Market Week New Year's show. If you haven't watched that show, please go watch it. And we have it all sorted out in clips also on YouTube. So if you want to just watch each of the clips, you can do that. But there's been a huge amount of action and many people watching our projections for the stock market for the coming years. So do go, if you haven't seen it, please go watch that show that's on there. Now, with that big gains that we're seeing, of course, this was our target up here around 38.20 on the S&P 500. It could go through that, of course, and momentum is strong, but we doubt it would be by much. And if you look at that show, we show that 3 graphics of the incredible historic valuations that we see here in the stock market at levels that are beyond anything close, well beyond the overvaluations that we saw in 2000 in that dot-bomb bubble period. The argument, of course, and I get this all over social media and emails to me, is that the dollar has nowhere else to go. That argument, in my opinion, is getting old, and especially now as interest rates are moving up, that may not be true anymore. And the fact that the massive fiscal stimulation that's likely to be coming out of the government now, that's going to keep the Fed from doing anything crazy anymore. So they've been looking for fiscal stimulus, and they're getting it. And the time for us is right for a top. We talked about it coming in the next couple weeks, and we still think that's going to happen without much more progress on the upside here at all. Coming up a little later in the show, we're going to show you again our projections for the stock market and why. We're also going to show you the gold market, which I think you're going to find quite interesting also. Stocks for the week right now here at midday on Friday, major indexes up between 0.5% and 1.3%, except for the Russell, which is up around 5% for the week, even a little bit more than that, as there is a lot of hope that the fiscal stimulus we're going to be seeing is going to bring life to zombies. Bond market 30-year up about 2.25%, down about 2.25% as the TNX, the 10-year, soars 18 basis points and moves that 10-year yield up to 1.10%. That's getting up there, and if you watch our New Year's show, you'll be able to see that we think that number is going much higher, that we'll see yields much higher this year. And yes, that's in spite of all of you that think the Fed won't let it happen. Gold, we saw this week a huge range, about $120, as it fails from a very important resistance area, now down over $40 on the week, as it's had a very large decline on Friday. It had a big drop on Wednesday and now down at some point here during the day, down over $60 on Friday. Silver also is weak, but not as bad as the gold market. So I'll show you that as we move a little bit further in the show, where these important levels are and why I think that at least on the short term we've had a breakdown. The dollar for the week up about 0.2, and this was a short-term reversal and what looks like a bottoming pattern. We have projections for the dollar that are lower than these levels, but on the short term, it does look like it's found a bottom, and the higher interest rates are helping it. Oil market up more than $3 to a recovery high, got up as high as $51.80 for light crude, as OPEC extends those cuts out into February, and that is giving a lot of hope to the oil market. We had originally had a target up around $49. We've now since raised that up close to $53 for the oil market. So we would think that there is some more to go. That's not a huge move in there, but there is a potential for some further gains to the upside. I want you to make sure that you go to the AskSlim site and explore. If you're new, look at that. Become a free member to AskSlim.com so you'll get a lot of information from us. If you're watching this on YouTube, make sure you like this video. Give it a thumbs up. That is helpful to us. Subscribe to this channel, and then you'll be able to see a lot of these clips that we put up. We put up 4 or 5 every single week, so you'll get a ton of information and learning about how we approach the markets. And click that notification bell so that it'll let you know when we've posted something. Follow us on Twitter at askSlim. And for membership info, questions on our huge offerings of education and analysis, write to Matt at askSlim.com. We're going to jump into the gold market right now. As I said in the beginning of the show, gold moved down pretty sharply this week on a couple of times. I'm going to start out by moving a chart into here, which is the weekly chart. Now, we show weekly charts. We do our analysis for weekly, actually monthly, weekly, daily, and intraday charts, 2-hour charts that we show also, which have a lot of great information on it. I'm going to show you some of that right now also. So here is that chart for the gold market. We're looking here at about a year and a half. As we go all the way back, we're looking at 2 years, over 2 years, as we go all the way back to 2018 there. If you want to learn about our cycle analysis, go to askSlim.com and click on the cycle analysis workshop on the top tab, and there's a lot of information there about cycle analysis and that workshop. So this is the gold market. If you look here, you can see our cycle analysis. These are called cycle brackets on the bottom. And they tell us an average distance. It's a drawing tool, and that's a guide for us for the cyclical rhythms. You can see this big cycle right in here. It started here at that low and bottomed here. And this is what's called nesting, where all three of these cycles come down at once, and that brings you the largest declines. Each of these big ones are made up of two smaller ones, right here and right in here, a half cycle, and then there's a quarter cycle in there, a smaller one also. You can see each of these half cycles, we have the percentage gains for each one marked off. 13%, 24%, this one made a 23% gain, this one made a 24% gain, and then they all bottomed right here in this area of nesting again. That had us bullish and looking for the market to go up significantly. That actually has not changed yet, but we are in a period right now where you have to say to yourself, is there we ask the question when we get a breakdown on the shorter term patterns, how much damage is going to be done in here, and can it survive moving down the way it has? You can see right up over here, 1965, actually on the daily it shows I think 1972, is the spot where the market had big resistance. And we said that's the area it needed to get through in order to move up to that new high or over 2100. And this is that big cycle projection that you can see right up over here into that fib extension zone. The minor cycle right over here that you can see is the one that topped right here and now is coming down, and it broke this important daily low at 1863. That's that line right over there. Now that breakdown is negative for the short term, and it could mean that all of this time period right over here in towards the middle to the end of February could be a time when gold struggles. This dashed line you see over here is silver. I'm not going to show the silver charts right now. We show that in Future Speak on Wednesdays, and if you will watch that show, you need to be a level 2, 3, or 4 member. Then you'll be able to see our silver analysis and a total of 24 different indexes and futures contracts. So this important level right over here, 1840, is the 61.8% fib support level. Right over here at 1800, approximately 18 to 1805, is the 78.6%. This level getting broken here would be bad. It would be very worrisome for the big picture. As long as it's hanging out in this area, the big picture is really okay. We think it's okay, and it will probably be dancing around and chopping in this area, eventually come down here and test under these levels, and then begin moving up again. So this is somewhere mid-February, and now looking out over here into March and maybe April, and then some more correction right over here, and then these move up again, and then over here in May, June would be time for the upward surge. Again, if we get under here, it will be worrisome. If you get under this level right over here, that last low, which was right around the 1765 area, it's over. This whole scenario for new highs would be dead. So that's why it's important in this area. We are going to look for some chop in here and even getting its footing after a little bit of time and trying to rally up in here again and then chopping down. Hopefully it will hold, it'll consolidate in this area, and then be able to have this move up here into this March period, maybe April. So very important time here. We're going to call it a short-term breakdown and a little bit worrisome, but on the longer term, okay. Now, just for a little better picture of the short term, so you get an idea, I'm not going to show the daily chart, too much of our proprietary information in there. I want you to sign up to be able to see that. But I'm going to show you a little bit here on a little different chart where we're looking at the gold market on a 2-hour chart. Now, we do a lot of analysis on a 2-hour chart. And in this case, what I have put in here is the Slim Ribbon PO, Slim Ribbon and Slim Ribbon PO. This is a Slim Ribbon right over here. The Slim Ribbon PO is a signal indicator for the Slim Ribbon. This, you can see when the Slim Ribbon is moving up and it's positive, then you have a condition where it's likely you're going to get an upward move. The Slim Ribbon PO, it turns green over here, and green is positive. These are just simply signal indicators which are confirming the positive condition and telling you you'd want to stay long, and telling you, well, if you're not long, you might consider that as an indication that you can you can put on a long position, or you can maybe add to a long position. You could see how well that would have worked right over here. This is not really buy-sell signals at all. It's condition signals for momentum. And you can see in here how well that worked. Look at this, as you had the big upside gap here at the beginning of the year, and then the downside gap here on Wednesday. It left this island over here, which is not good when you see something like that. And then, and by the way, it's better for these purposes to not have a 24-hour chart up, because then you get the clearer patterns. So what happened here, as you can see right here, is the Slim Ribbon turned negative for the very short term. You can see that signal right over there, as this is now turned negative, and it's telling you that rebounds are likely to fail. So the very short-term conditions, or near-term conditions, for the gold market, and this is GLD, we're using the ETF here for this example, is telling you that rebounds are not likely to hold, and the short-term condition of the gold market is worrisome. And at this point, negative. Even though I'm still positive on the long term, intermediate term all still looks okay. The shorter term now is giving signals of some problems. So this is always the first domino to fall when that happens. And hopefully the rest of them won't, because the longer term momentum patterns are still positive. And when I go back to this chart right over here, which is the weekly chart, you can see our momentum indicator, which was coming down right over here on the weekly chart, had turned up. And you can see that right there, and it's still pointing upward. It may not hold it for long if the downward pressure stays in here. So I wanted to show you that about gold, looking at the Slim Ribbon PO, which I think is an excellent indicator, giving you warnings for the near term that the gold market has some problems. Now, the silver market has not given that signal yet, and the silver market is stronger than gold, and we expect the silver-gold ratio to continue to improve as far as that goes. So that's a look at the gold market, and hopefully that was great information for you as you see the style of analysis that we do. I want to tell you a little bit more about that coming up. This is the AskSlim membership page. If you go to AskSlim.com and scroll down, you will see this. And I wanted to give you an idea of our memberships that we have here right now. We have a free membership, and that allows you to see the Market Week archive, which has all of this great analysis in there, and you'll have access to that archive and notified for that, and some special free videos that we give you. Our level 1 deal, we call that one, and you can see deal, bet, raise, and all in. Yes, poker terms. I am a poker player. And this one for the level 1, this is a great membership because you get not only the Market Week show, you get our Slimulator Momentum Tracker, and you get the Stock Index Report, which is a weekly outlook, and the ETF Weekly Report. So you get a lot of reports in here, and there's some surprises coming for level 1 that we're going to be bringing you also. Level 2 is a great, it's great because you get everything in level 1 in there, and you also get our SIR daily snapshot, SIR intraday, which has the fantastic for intraday traders. It's our live stream, live, and 15-minute charts with the 3 major indexes for trading, and you get our entire library. It's actually well over 500 videos right now with these 9 different categories of videos that you get. For our raise level, level 3, you get all of that in level 1 and 2, plus you get our Slimulator ranking system of the 84 best traded symbols Unbelievable. It has all of our algorithms in there. You get our trading ideas. RV runs that. Amazing, absolutely great work that he does, and he shows you a video and teaches you on every single one of those trade ideas. You get our live chart streams, which is in beta of the work that we do in the major indexes, and you get our weekly top chart requests. And level 4 members can ask us for analysis, and we share that with people in level 3. You get the static charts and learn about that analysis, and email support on general trading challenges that you can write to me or the team. All in, this is everything in levels 1, 2, and 3, plus you get my annotated cycle charts for the Thinkorswim platform. So you really need to be a Thinkorswim member, our preferred broker, and if you want to open up an account there, please go to the top page and scroll on that carousel and use our link. You get our chart grids and templates for the TOS platform, custom chart requests up to 2 a week, where anything you want us to look at, we'll do that for you and apply our cycle analysis to that. And you get actually our 3 proprietary indicators now: the MCI market condition indicator, OBI, the askSlim option bias indicator, and then now we're adding the new Slim Ribbon PO, that great looking momentum indicator, signal indicator that we give you for momentum and for you to be able to direct your positions in a way that gives you the greatest advantage. So that's what the memberships are. You can see that. What is included in all this? Well, you get our unique and unparalleled technical methodology developed over 5 decades, because I've been a trader since 1974 when I became a member of the CBOE. I've also been a member of Chicago Mercantile, Chicago Board of Trade, and a hedge fund manager. You get our technical methodology, which is based on unbiased, bull-bear agnostic approach to charts and analysis. Yes, you might hear me bearish on the stock market at times, but we look at the technicals, and that's all that's important. We specialize in cycle and momentum studies at multiple time frames, and our premium membership levels support traders of all styles and experience, from intraday scalpers to swing traders to position traders and investors. Our team of analysts provide coverage of the major stock indexes, ETFs, futures, markets, with energies, precious metals, foreign exchange, bonds, Bitcoin, holy cow, and many of the most liquid stocks that are suitable for option trading. So really deep analysis in 84 of the best option traded symbols. Right now, you can get special rates. A 3-month trial membership. The rates that you saw on that page, well, we're going to beat those by a lot. You want to know about that for more info, write to Matt at askSlim.com. He's going to send you a link, and if you have any questions about that, you will be able to ask him those questions also. So that's a look at our memberships, and I hope you found that incredibly interesting. We want you to become a member because your success is our success, and we work so hard to make you a more successful trader and investor. That's what we live for. All right, market week, stock market, 1 to 3 month view. All right, so we're going to look at this a little bit differently. I'm going to start out discussing the Russell 2000, RUT. We're going to look at that cycle analysis, and you're going to get some sense about what I think there. And I'm going to show you an overbought, oversold indicator that I think is important to look at based on this analysis. So we're going to start out right over here, and I'll switch from this gold over to the weekly chart of the Russell, RUT, and this has our cycle analysis on there. So we're going to look at these cycles right in here, and you can see the clarity in the cycles, despite the fact that the Russell has been in a monstrous up move. Now, when you have this big cycle right in here, and these corrective periods don't bring you much of a decline, we call those right-hand translations. In other words, this minor cycle peaked on the right side of the ideal. The ideal peak would have been right over here. It peaked right over here and gave you a modest correction. This one peaked right about over here and gave you a modest correction. Those are very bullish occurrences. This right over here was a double star pattern that fooled me, as it normally would bring a top to the market, but then it surpassed that and it failed really and began to move up. And now you have this extreme swamped area right in here where a correction was due and it didn't decline by very much. Because we've had these two very, very big upside moves in here, the likelihood is strong that when you get into this corrective phase over here, it will give you somewhat of a significant correction. Now, significant correction, well, you might say that's 5%. Would you call that a correction? Well, I would. You might say it's 10% or even 15% because those are all corrections. If you look right over here at that large decline way back over there, of course, that was monstrous during that period of the beginning of the scare and lockdowns for COVID-19. So we have not had any real declines since that period. And now we're in this rising phase. It's either first week or the third week, I can't really tell, of that rising phase. And my assumption is that we're going to have a rather full-fledged correction coming up here. And that's been my assumption for the stock market for a long period of time, that it would rally up into January at some point, maybe late January, as you can see us projected right up over here, and then beginning a correction. Now, I'm going to show you something that really enhances this analysis, and that, why would I expect a correction to be coming? And that's because of a condition that I think is really overbought for the Russell. Of course, the Russell doesn't have a lot of earnings to it, and some 18 to 20% of them are considered zombie stocks, which are stocks that just have massive losses, may never even earn any money, and have been helped a lot by Fed policies, and now will certainly get some help from fiscal spending that's going to be coming up now that Democrats own the world. So that's going to be likely coming, but the markets already know that, and it's priced this in, and I'll show you how far it's priced it in a moment. So our projection right over here when we look at this is for some higher highs coming right now for a couple of weeks potentially, and then turning down. And right now we're projecting right over here to a number of about 1840. We'll come back to this chart in a moment, but I want to show you why I'm projecting that. This is a chart of the Russell that's probably a little bit different than you've ever seen. Let me just get it in here right now. This is a Russell weekly chart with the slim ribbon on it. So the slim ribbon offers you momentum conditions, and generally when the slim ribbon is really flat, you're not getting much momentum. As you see, the Russell really struggled during that period right over there, and then of course it had this big correction from the COVID scare. Now, scares, the reality of COVID, and I don't want to downplay that because now we have had 4,000 deaths in a day, so it really is, of course, a nightmare situation. Now, if you look here, as you look back in these few years back, the disparity index, which shows you the amount over, in this case, the 13-week moving average, or the amount below the 13-week moving average, gives you conditions of slightly overbought or very overbought or oversold. And for a long period of time, it was like, so right over here, 7% overbought was a lot. And then when you got down over here, 5-6% oversold was a lot. That's the amount of distance above or below that 13-week moving average. That's the middle of the slim ribbon, the blue line. Here, of course, is that big break, and then something has changed now as volatility has increased, and this is what's important about this. We're now looking at levels of overbought or oversold conditions that have changed a lot. I want you to note here, this is the zero line. So this is when it approaches the 13-week moving average on the downside. It has not gotten worse than about 2.5% on the downside below that 13-week moving average at any time, all the way back since May. What is significant is when it gets above that 13-week moving average and how far it's likely to get. In this case, the overbought condition above that 13-week moving average was almost 12%. In other words, the amount above that 13-week moving average got about 12%, and then it lost about 13% of its value as it came back down to that 13-week moving average. If you look over here in August of this year, it also got significantly above. At this point right over here, it got to a level of about 9.5% above the moving average, and then fell 13% actually, as it got only down to 2% below the moving average right there. But it appears that there's some trend setting up in here where it can get up to some extreme level of 13% or so above the moving average, as it did right over here, and this about 10%. And then it started to be able to get up here in this buying panic that's going on, and now has reached the highest level right now of an overbought condition of about over 13% above the moving average. Now you could see the 13-week moving average here, and how far above it is there right now, which is pretty extreme. So right now, if it fell back down to this really, which is a magnet, the 13-week moving average is a magnet. When it gets way above it, it's going to come back down to it. And if it got back down to it right over here, it would be a 12% decline from the high that we have. So the high may be in, it's not likely. As I showed, it's likely to be moving a little bit higher over these next couple weeks. But then because we're at this extreme level that we're talking about, it's likely to have a pullback of some significance. This one was about 3 weeks on the downside. This one in here was about 3 to 4 weeks on the downside right over there. And now what we're going to do is go back to the chart that I just showed you, which is that Russell 2000, and we're actually looking for a peak over here and then a decline from around February 1st to about March 1st, which would be a 4-week decline. If it were to give up about 12% as we're looking for, it would take it down to this very high level for a correction of the major 23.6%, which would take it down to about 1840 on the downside. That would be a 12% loss, and in line with what we see happening in the past of these corrections. Very, very normal occurrence, and why we think that this decline is coming through this period into this early part of March for the Russell and for the stock market. Then we have to see what happens in here. My bigger picture perspective, I don't want to give away too much of it, but I think there's a major failure coming in here where it comes tests where it's short of it or a little bit above it, and then the period out over here brings another very big down leg for the market. But that's further out there, and everybody's going to dispute that because, of course, the Fed is going to hold everything up. But I disagree with that premise moving forward. So that's a look at the Russell as we look at this at the stock market indexes in here. We're going to switch over now from the Russell to the S&P 500 and extrapolate from that as to a similar occurrence. So if the peak is coming in here as we expected, and all of these yellow ovals that you see are the corrective zones in there. You could see this yellow oval right here where these cycles came down and nested right here, and then this period right over here. We projected in January it would get up to about 1817 to 1820. It got up intraday to 1824. It could certainly go through there. We're looking at the fib extension zone off of the daily chart to get those numbers. And then if it fell, as we anticipate, equal to that of the Russell, and maybe it won't be quite as much, maybe it'll only be about a 10% move, well, that would get you down into these areas right over here. That's 34, 35, 34, 25, right around over there, where we think the correction is going to come. Yes, 350 to 400 point decline in the S&P 500, which would not be very much under these conditions. We've had up here for all this time, the pattern suggests stock market holds up into January and big risks through early March. Well, projecting a 10% decline is not big risk. It's just simply a modest correction. And when you look here at these corrective periods where each of these cycles nested, as we're looking at right now, each of those brought pretty significant declines. Of course, this was a crash, significant decline, and 10% would not be that excessive in here and it's due. It's due to come right now. And as I showed you in the Russell, maybe that one, which has been guiding the market up, will be the one that begins to bring the market down. Now, market up today on Friday, but the Russell is flat, so maybe it is beginning to stall in there. NASDAQ and the stock market still holding up right now for gains on the day, and these gains on the week that I talked about earlier in the show. So for the S&P 500, we're going to look for some waffling around at these price levels, and then sometime in the next 1 to 2 weeks, making that top and then beginning the corrective process that we see in here towards that major 23.6%. If this gets a little higher, these will move up a little bit, but it'd be pretty reasonable to expect 34.30 to about 34. This is the 50% here, which is 35.10 approximately. That would be a best case, 35.10, and this is a more likely around 34.30 on the downside as we look here over this next 6-7 weeks is what we're really projecting out for the S&P 500. So correction of some 10%, maybe 12% in the Russell, that would be, in our opinion, modest and very likely and very consistent with money flows, and that's what cycle analysis shows you. Essentially the flow of money. Momentum in here, as you can see right there, still giving you strong signals, and it's going to have to be rolling over, which would take some significant downside movement to give us that sign that this cyclical corrective phase was in play in some significant way. That is a look at the S&P 500 as we look at our cycle analysis in here, and very, very busy charts with a ton of important information in there. Yellow phases are corrective phases, and we're about to enter into one of those sometime in the next couple of weeks. That is it for this show. I hope you found it absolutely informative, immensely elevating and illuminating to you with all of the information that we share. I want you to remember, go to the askSlim.com website, explore it, subscribe to YouTube. You're a new member. If you're new, become a free member to AskSlim, so you get a lot of our information. Make sure you give this a thumbs up on YouTube. Make sure that you do subscribe to our channel and click that notification bell so you know when we put videos up. Follow us on Twitter at askSlim. And regarding all of those trials that I just showed you, write to Matt at askSlim.com for info on the trials, on anything else on our site, or questions about our huge offerings of education and analysis for traders and investors. That's MATT at askSlim.com. That's it for this show. I just absolutely hope it was fantastic for you. I want you to be so careful because it is so crazy out there. And we're always wishing you great trading.
Well, I'm going to sit